You're listening to Shift, Human First Financial Guidance with Ross Marino.
Today, we are shifting the conversation with Dan Ariely and Kristof Gleich. Hello, gentlemen.
Hello, hello.
Hello, great to be here.
Welcome to the show today. You have a fascinating company and you have a fascinating business that both of you are together involved in. And it started, based on my reading, when you had this idea to explore how corporate culture impacts company performance. And I know both of your companies actually work along this. Dan, could you maybe start off and tell us, what kind of sparked the idea to explore that?
Yeah, so I have two hats. I have a hat as a professor at Duke. I do work on what's called behavioral economics, and I study how people make financial decisions, health decision, and human motivation. And I spent years studying human motivation, a little bit in the lab, a little bit with one company at a time. And about 6 years ago, David, my partner at Irrational Capital, came to me and said, look, when you go to a company, you can always seem to kind of improve productivity. But can we look at the market? And can we look at companies who are doing better and doing worse? And would this be a good tool for investment, to just invest in the companies who are doing better at this? And in the standard arrogance of an academic, I said, of course, everything we find in the lab seems to be working. If we can identify the companies, that will be great. I just don't know if we'll have the right data. So I had a lot of confidence that we have codified a lot of elements of human capital in the lab, in experiments, and so on. The question is, could we look at publicly traded companies and get the right data that would tell us how they're doing this? So we started a long journey of looking for the right data. And we ended up with two sources of data. One is proprietary. Think about something like satisfaction surveys that go into companies and ask you questions about all the way from how much you like the coffee to what's your health benefits. And we also have data from public sources. Think LinkedIn, think Glassdoor, and so on. And we basically have data that goes back to 2006. And we basically say, can we characterize a company, depending on what we know already about human motivation? Can we separate the companies that are treating the employees better and worse? And would that have an effect in terms of alpha? And we spend a long time trying to do lots of analysis and lots of looks and lots of thinking about the data. And we finally ended up with an answer that we think the answer is yes, which means that both the principles are correct, but also the data is good enough to support it. Since then, of course, we keep on trying to improve both of our understanding and the data. It's an ongoing process. We haven't finished, but we codify that. And then the question is, what do you do with this? So we have imagined the Fortune 1000, and imagine that every company has a number that says, what is the human capital? What is like the human energy that powers that company? Now you have all of this, and now the question is, what do you do with it? And that's happened to be was very lucky for us to meeting Kristof at that time. And maybe Kristof, I'll pass the mic to you.
So I'm the president and the chief investment officer of an investment firm in Chicago called Harbor Capital Advisors. And what we do and what I do is look for skilled money management approaches across the world, across different markets, equities, fixed income, commodities. And we're looking for investors that can generate strong returns by investing in public markets. And, that usually leads us to whether it's finding a value investor or a growth investor. But what's unusual here is the innovation behind the signal. I'd never seen anything like it. We're talking about measuring the value of human capital. Dan said the word energy there, so I'll riff with that for a second. So if you think about the first law of thermodynamics, energy can neither be created nor destroyed, it can only be transferred. And when you think about culture, I think culture is that transmission mechanism within a company that takes, if you have a good culture, you take from the well of potential energy and you transfer it to kinetic energy. If you have a bad culture, you take from kinetic energy and you transfer it back to potential. Said differently, companies with great cultures, engaged employees, perform, the whole is greater than the sum of their parts. And those that don't, the whole is less than the sum of the parts. And that's key to really kind of understanding. And then what follows from that is companies that do a great job of investing in corporate culture, engagement, motivation, bringing that kind of all together, it's going to translate into shareholder returns. So that it was just personally something that I believed in, having been a career professional for 20 plus years, having worked in different cultures before and having observed by investing in money managers, different cultures, it's so important. Every business leader says our number one asset is what? Our people. And with Dan's firm, they figured out a way of empirically measuring that. And ultimately, we've partnered together to create 3 ETFs that make this now investable so people can benefit through stronger returns by investing in great human capital.
And if I can steal something that Kristof helped me think about, which is that really human capital is an accounting mistake. If you think about it, a company that invests in a warehouse, it's an investment. A company that invests in its people, it's a cost. That shouldn't be like that. It should be, companies should have on their asset sheets human capital. And they should think carefully about how they're investing in human capital and what does it mean and so on. But right now it's missing. Like a piece of the quarterly report and annual report that is just missing. It goes into the cost, but they don't think enough about the upside. About the
So for
value
me
of
as
that.
an investor, something that isn't recorded correctly, it's not accounted for. Good human capital should be capitalized as an asset on a balance sheet, like a factory, but it's not. That suggests an inefficiency. How do you generate stronger returns in markets? You spot an inefficiency and then you create a structured investment process to positively exploit that inefficiency to generate strong returns.
Yeah, if I remember correctly, there was some quote, I don't know if it was Carnegie, where he had said you could take away, and I'm paraphrasing and butchering it, take away the money in the factories and everything, but if you leave me my people, I'll have it all back in X number of years. I think it was a Carnegie quote or Rockefeller, somebody.
Sounds like Carnegie.
Yeah. So,
but whatever it is, it is very clear that if you think about the question of what makes a company function well, it's individuals, and it's not just individuals. If everybody do just what they're told, like an Italian strike, right? Everybody just work at the minimum level needed. We understand that no company will ever improve, right? We rely on people to do above and beyond. We rely on people to search for innovation and improvement and helping each other and mentoring younger people and so on. It's a machinery that runs on goodwill. And the companies that are doing better on that are obviously more successful. Going back to your point, your quote from whoever it was, we saw that the value of human capital became higher during COVID. Why? Because if you think about intrinsic motivation, when you're in the office and you're in a meeting, there's all kinds of things in the environment that forces you to pay attention and to work with other people and so on. The moment people are at home, there's more left to goodwill, more left to intrinsic motivation. And to the extent that work from home is here to stay, not maybe 5 days a week, but work from home is here to stay, the role of intrinsic motivation is also going to keep on going and increasing. And the companies who are going to do well on this will do much better.
I think from my perspective, I don't approach this thought with almost any level of skepticism. It's about the people. We know that. It's almost like an assumed statement that the business is only as good as its people. I get that. I understand it. I've lived it, having startups and businesses myself. But to translate that to an investment strategy over your course of research, you two obviously came to a point where you said, we've got to do this. This isn't just a good idea. This is something that we need to do because it's that important. Dan, can you take us through maybe that moment when you said, we've got to do this?
Yeah. So first of all, I think that you're absolutely right that everybody recognizes that human capital has to be important, right? Nobody would say, let's take the companies that have high human capital and let's short them. I mean, nobody would say it's a bad signal. But what is important, and social science has proven over and over that our intuitions about what matters are not always what really matters, right? So there's a desire to invest in human capital, but then there's understanding the secrets of human motivation. And a lot of my work and the work of other people have shown that people have biases. For example, we think that higher bonuses are always the best way to motivate. No, sometimes they actually demotivate people. We truly don't understand what it is. And I, for example, did a lot of work on the feeling of being appreciated and showing even small ways of being appreciated make the big impact. And indeed, in the data, we see that echoed in a very big way, that people feeling appreciated makes a big deal. But for me, the question, the moment we got the data, and after about a year of analysis in which we managed to convince ourselves that this was real, that was the step of, okay, now that we have the data, that we have strong sense that it's not just a theory, but we have the data, now it's a time to do that. And then we had the extra benefit that the nice people at JP Morgan in their quant group wanted to look at our data and get their own independent view of that. And as an academic, that's always very good, right? You want peer reviewed, you want somebody else to look at that. And when somebody else who's an expert, as a newcomer to that field, it's a very strange field when you come from the outside. By the time you get used to it, you don't see how strange it is. But it's a strange field with language and beliefs and so on. So coming from the outside, the JP Morgan reports were very powerful, and as a say, this is a time to really get going. And I have to give a lot of credit to Kristof here, because when the moment I convinced myself that we have enough indeed good data, I went to somebody that I knew on the Duke board that runs a very large fund. And I told him about this, and I told him the data, and I showed him, and he said, no, we are fundamental investors. And I said, what's more fundamental than human capital? How can that not be a part of the fundamental? He said, no. So that was, for me, a kind of a low point, because I realized that the industry as a whole has been used to talking about a few things that are kind of in the conversation, and there are some things that are just out. And then it's very hard to even consider it. And Kristof was willing to take a real look.
I'll add to that. So I'm of the belief, we're of the belief that the explosion in data over the last decade is going to lead to new insights and new sources of alpha generation that just didn't exist 10, 15 years ago. So sort of as a starting point, as an investor, I'm very open-minded, very sort of focused on innovation. And I think, markets are very, very efficient. And I think in order to kind of stay ahead, you need to kind of keep looking forward and embracing incremental advantages to an investment process. And so being open-minded with regards to data and newness. And there's a lot of inertia in our industry. So when I heard and saw and read the research and looked at the results of the research, I was just naturally intrigued. Now, my job as an investor is also to be cynical and skeptical, and I was. And my initial hypothesis, so whenever I'm looking at any approach to money management and I look at returns, I assume all those returns are due to luck. That's my kind of null hypothesis. And then I need to try and reject that hypothesis. So when I looked at this, my initial reaction was, love what they're trying to do. Sounds great, but it's probably just other factors that already exist and are known factors repackaged under a nice marketing umbrella. And so I thought when I kind of really rolled up our sleeves and did the work, we would see a small cap effect, a quality effect, and a momentum effect, and then probably nothing else left over. And so when when we really kind of got serious and thought we've got something here, is when we did all of our due diligence and did all of our factor disaggregation and portfolio analytics and all that kind of stuff that we do in our lab. And I was stunned how idiosyncratic the returns were, and they weren't explained by other common factors, which then kind of makes sense when you sort of start piecing this together. Well, they're looking at data that is very proprietary and not everybody kind of has access to this data. So how on earth would a risk tool explain their data insights by other common factors? No, there's going to be an unknown, which is the alpha of the signal, and that's ultimately what we're looking for. And then when JP Morgan ran some significant research, so JP Morgan's sell-side research run by a gentleman called Mark Kalanovich and Karun Chowdhury on his group led the research. I used to work at JP Morgan. I know how good that group is. And when they published a 40-page independent validation showing that this signal, the human capital factor signal, was orthogonal, not explained by other signals, it starts to line up. And then we started talking about how do we bring this to investors? And ultimately we decided that creating indices that reconstitute once a year, because this signal is quite long versus other quant signals. You get quant signals that decay in a matter of, minutes at the high frequency scale, but this one decays with the frequency of years. So bringing something to the marketplace that reconstitutes once a year as an index, fully transparent in a low cost ETF was for us a no-brainer.
I'd imagine it'd be challenging to work with different partners as an investor, as an investment company. And, each relationship may have some nuances about it. Irrational Labs is maybe a little different than your typical partner or typical maybe data source that you would have from Harbor. Kristof, could you talk about maybe how you work with them and some of the challenges or the unique aspects of it?
Yeah, I mean, Dan's calendar's challenge number one. No, I'm kidding. But you're right, it's different. So from a first principles perspective, the engine inside these ETFs is driven by Irrational Capital. Dan is business partner, it's Scott, their CIO. They are the engine inside this ETF. And then our job is to kind of wrap an ETF around this engine, make sure we have an ETF that gives good exposure to what they're doing in their research, do all of the compliance, the operational, the legal oversight, work with all of the market makers and capital markets to make sure it trades with nice spread, and then ultimately to get the story out there in the marketplace and try and educate the market on this new factor. New factors don't come along very often. People are familiar with value, people are familiar with quality, people are familiar with momentum, but people need to get familiar with human capital. And so look, this is a long-term process. We work with Irrational Capital as they're sort of classified as the index provider, and we essentially do everything else. And then we partner with Dan on things like this as well, just to help kind of educate and create awareness of this. But then also we do ongoing due diligence. We're big believers in back to that C word, culture. Culture of continuous improvement is something that we look for in any of our money managers, whether they're more traditional equity managers, or in this case with Dan and Irrational Capital. So we want to make sure that they are continually investing in their own R&D to make sure, in this case, the human capital factor is as cutting and as leading edge as it possibly can be.
Yeah, if I can add one other thing, so I think that one of the exciting things about human capital is that it's an investment, but it's also an important tool to reflect on our own lives, right? Because once you understand, for example, that feeling appreciated really matters, what are you going to do differently tonight at home, right? And what are you going to do differently with the people that you work with? And we are surrounded by thinking all the time about what it is that makes people happier and achieve more and motivated and so on. And it's very much a part of our culture, right? It's our mindset. We keep on looking for opportunities to improve both the investment and the way we work. And I think that our partnership with Harbor and with Kristof feels very much that we are not two companies.
I think I had an email newsletter a couple of days ago. I think it was from Behavior or Decision Labs. And it was talking about the number one benefit of working together versus remote. And they said it's those face-to-face interactions, exactly what you just said, and how important that is. And yeah, we've definitely lost some of that. But the final comment I wanted to make is why this is so fascinating to me. And what really caught my attention is when I see a new idea, some of them you really have to think about and listen to, and maybe they're over my head or they're a little deep. But when I heard this explanation from Kristof, I just thought, well, duh. Of course that's important. That's going to drive returns, where he didn't need to give me a 5-minute explanation. He just said human capital and talked about it. And I thought, well, yeah. So how do you quantify that? It was really fascinating. So I appreciate you guys being on the show. I'm looking forward to how this develops, how it grows. I'd imagine this is just the first step. I'm sure you have ideas. I won't ask you about them, but I'd imagine it's just the beginning. So Dan, Kristof, appreciate you being on the show today.
Thank you very much.
Thanks, Ross. Thank you.
Thank you for listening to Shift with Ross Marino. Please visit humanfirst.live to learn more. This show is for general information purposes only and is not intended to provide recommendations or advice. Speak with a legal, tax, or financial advisor before making any decisions. Past performance references are historical and do not guarantee future results.